Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Hello and welcome to Quartermaster, a brand new video show from ThePrint. I am YP Rajesh, managing editor and host of the show, and excited to introduce to you the nucleus of the show, or the master rather. As the name of our show says, investment guru Saurabh Mukherjea, founder of Marcellus Investment Managers and author of some landmark books on investment and growing your money. Welcome, Saurabh. Many of you would have watched our interview with Saurabh and his co-authors when their latest book, Diamonds in the Dust, was released, and the overwhelming response was, we need more of Saurabh on ThePrint. We are a very responsive media platform, and so here we are with a new show that will feature Saurabh every quarter, and therefore Quartermaster. But first, let me tell you what this show is not. You will not get advice here on what to buy, what to sell, what to hold, or what to accumulate. For that, you have the business channels, and they do a pretty good job. This show is all about insights and analysis, the big picture relevant to serious investors about the economy, growth, change, progress, wealth creation, disparities, and more. For instance, why are millions of new investors flocking the stock market? What is the change that has taken place in India in the last 10 or 15 years that is transforming the economy and helping people rise on the ladder to growth? You see that all around you. What are the new attitudes to learning, personal growth, and professional development when you have social media, WhatsApp, Twitter, Facebook, Insta, and online learning, and what is the impact of that on the country? Our very first episode is titled India, a Million Opportunities Now. This is the title Saurabh picked, and today we will focus on how has India changed over the past 10 years economically, technologically, and politically. Why those seismic changes are creating both enormous wealth creation opportunities and massive wealth polarization. How can people watching this, you, our viewers, benefit from these changes? So please fasten your seatbelts for the next 30 odd minutes or so as Saurabh is in conversation with me, after which we will take some of the questions many of you have sent, and Saurabh will answer those questions. So Saurabh, welcome to Quartermaster. You're the master, and if I may say so, I could be the quarter.
Thank you very much.
From India, a million mutinies now to India, a million opportunities now. What was your, on your mind when you picked that for the very first episode?
I mean, look, I think just to sort of reference the great V.S. Naipaul as we start the show, I know he's a controversial author for some, but I was, I think, in class 10 when I read back in 89, that remarkable book. And in that book, V.S. Naipaul picked up the fact that the country was awakening, aspirations were being aroused, people were on the move. I remember in the foreword of the book, he wrote that people were on the move, Indians wanted a better life. And it was remarkable. Remember V.S. Naipaul had written 2 prior books in the 60s and 70s, both sort of scathing indictments of an India. I think Wounded Civilization and Area of Darkness, both books were quite dismal. So I was in class 10. I was intrigued to hear from this, very Western, very British author that he thought India was changing. But the 90s, as many of you remember, were a tumultuous decade. Economic reform, some tragic events, the East Asian crisis, and so on. What's happened in the last 20 and especially in the last 10 years, Rajesh, is that the country has started getting integrated economically, right? I'm not sort of referring to the sort of Doordarshan style integration, which we've discussed, which we used to study in civics books in school. I'm talking about real integration, right? So for example, the number of people taking domestic flights has pentupled in the last decade. And this is including the COVID years. The number of people with broadband connectivity is up 50-fold, right? I could go on and on, but when you join a country up, when you integrate a country, you open up opportunities for people, you open up opportunities for well-run, efficient companies. And the transformation of a country happens when a country gets networked. So we saw this in America. If you read about America between 1880 and 1930, America got integrated in those 50 years. Transformation from a agrarian village economy to an industrial economy took place in those 50 years. Remarkable economic growth by the standards of that era, a raging bull market through the 1920s. Similarly, Japan after the Second World War. India is going through a very similar phase. Right, there is no. I make this statement without any political connotation. Right, India is going through a very similar phase where, through a variety of means, GST, telecom, roads, railways, airlines, people's own aspirations, the country is coming together. Small, well-run companies are finding national level opportunities, and ambitious professionals, hardworking, talented professionals are finding they no longer have to migrate to New Zealand, Australia, Canada, and the United States. They can actually build very well. They can build fortunes for themselves in our country, funded by venture capitalists and listing on the Indian market. And that's why I said, let's capture the zeitgeist, let's capture the theme of our era, of the era that you and I are fortunate to live in. This is the land of opportunity. I think it's about time we started discovering the opportunity and leaving the mutinies behind.
So, Naipaul was also optimistic in the book, as in after the first two books, this one was optimistic. So you're also going in the same path as Naipaul, although X times more.
Right. So let me sort of bring the economist out in me as well. Naipaul was optimistic for somewhat, what should I say, anthropological reasons, right? His view was that India was a sort of civilization which had been beaten up by a bunch of people, and the scars of that annihilation were gradually fading. Felt Naipaul, the scars were fading, and gradually the country was finding its feet. Now, Rajesh, I simply don't have a locus standi to take as grand a view of India. My view of India, our view of India, as we travel around the country, as Marcellus's analysts travel around the country, my view is more prosaic. What we have seen in the last 10, 11, 12 years is not just in big cities like Mumbai, Delhi, Bangalore, but even in smaller, more modest places like Ludhiana, like Sholapur, like Kolhapur, like Coimbatore, like Madurai. Even in smaller towns, we've seen business people raise their heads and say, we can expand our businesses, we can make something of our lives, of our businesses. For example, I remember going to Kolhapur 3 years ago. The Tanishq franchisee there had 1.5 story operation, small, well-run, prosperous Tanishq franchisee. I went again recently, a couple of months back, and the Tanishq franchise has doubled in 3 years. Right, it's still selling jewelry. It's selling jewelry in the wake of COVID, but it's doing good business. Titan is a listed company. You can see Titan producing sparkling results, and I can tell you sort of hundreds of stories like this of small business people, primarily men, I have to confess, but small business people prospering in corners of the country that we thought were really not going to do that well. And that revival, that rise of opportunity in the world beyond the big cities is what I think we need to understand. Those business people, those small businessmen are now coming to the stock market. Right? They used to spend their entire lives buying Government of India bonds, fixed deposits, LIC policies, and so on and so forth. Now they are saying, "Wo sab theek hai, all of that is good stuff, but I also need a slice of the India a million opportunities now," and hence the doubling in demat accounts in the last 12 months, Rajesh.
Just a small aside, Saurabh, you said you had to confess mostly men, and we are talking a day after Nykaa and Falguni Nair. So there is change happening there also.
Absolutely. Billion opportunities. So not a million mutinies, it's a billion opportunities. And it's opportunities which recognize that genders, caste, religion no longer are bars to rising in this country.
So, Saurabh, if we try and look at this a little more in a compartmental way, you talked about economic change, technological change, and political change. So let's tackle economic change first. So what are the big milestones for the economy in the last, say, decade, which we are talking about, or 15 years if you want to talk about it, or since the global financial crisis? What is the big change you have tracked?
Sure. So I think that the simplest way to understand the big economic change is to look at the concentration of profits in our country, right? So back in, say, 2009, say in the aftermath of Lehman Brothers, the top 20 Indian profit generators would have accounted, Rajesh, for say around a third of profits in our country. Roughly one third of the nation's profits are going to the top 20 profit generations. If you cut to the current day, the top 20 profit generators in India now account for 80-90% of the nation's profits, right? So basically, the largest companies in each sector have ended up becoming very, very powerful in many sectors. In many sectors, the top one or two companies now take home 80-90% of the profits, right? And that rise in economic concentration, rise in profit concentration, more accurately, that rise in profit concentration, I think, has become the defining sort of hallmark of India over the last decade or so. Now, the result of that, depending, and this is where people's political convictions become very, very relevant. If you are of a free market school of thought, you will say, well, now we have at last, finally, we have large Indian companies like, say, TCS or HDFC Bank, who can go head to head with the best in the world. And if you're of a more socialist grain of thought, you will talk about the annihilation of smaller businesses who've not been able to keep up with, say, with the dominant players in the industry. But economically, I think this is the defining change: consolidation in multiple industries, and as a result, profit concentration trebling from 30 to 90% in the space of a decade or so.
And what helped that change, Saurabh?
Right. So this is now, let's go into the technology aspect. So broadly speaking, right, if you look at the way the country is integrated, I mentioned the broadband jump and so on. There's a couple of other technological aspects to consider as well. The rise of cloud, mobile, and what's called software as a service has been incredibly liberating for smart companies. So a decade back, smaller companies in any sector wouldn't be able to, say, afford Salesforce or SAP, right? You'd have to be a large company, call in a systems integrator, Accenture or a TCS, spend millions of dollars implementing SAP or a CRM platform, right? Because of the way software has changed, software is now available as a service. Even if you're as small as Marcellus, provided you're technologically savvy, a small company can now implement the world's best software on cloud using mobile. So what we have seen is not just the fact that the countries got integrated through roads and airlines and mobile, but the nature of technology is also changed. And companies which have access to technological talent can now leverage that technology at very low cost to ramp up growth very, very efficiently. So you mentioned, you name checked Nykaa, and I think you rightly did so. Nykaa's meteoric rise is an example of how relatively low cost modern technology can create a powerhouse company in the space of a decade, right? So that's one aspect of this rise in profit concentration. Another aspect now goes back to sort of political / economic change, but it interplays very nicely with technology, is GST. Right? After whatever 14, 15 years of political horse trading, back in 2017, the country rolled out GST. Now, as soon as you roll out GST, you integrate a fragmented tax structure, right? We used to have state level tax structures for indirect taxes. We moved to national level. Now, as soon as you create a unified national indirect tax structure, you give companies the chance to integrate their procurement and distribution networks. When you give companies the chance to integrate at a national level the procurement and distribution networks, companies which are more technologically savvy, logistically capable, are able to avail of the integration opportunity that much more. So then you now interlock these three changes, right? Your transport infrastructure is being integrated. Your telecom infrastructure is becoming more powerful. You have GST, you have UPI. UPI allows people to pay across the country without having to make recourse to currency. And then finally, you bring in GST. And serendipitously for us, all of this has happened in a decade where cloud, SaaS, and mobile has made low-cost, world-class technology available even to companies with turnover of a few crores, right? So these things have collided very serendipitously for India. I'm not saying any great sort of genius has orchestrated it, but it's really hard, Rajesh, to think of too many countries where these sorts of changes have coincided so auspiciously in the space of 10 years. The beneficiaries of this are the what I call the diamonds in the dust. Beneficiaries of these are companies who are able to leapfrog their smaller rivals and rise to sector dominance, and thus create wealth for their employees, for their shareholders, and for the nation.
Saurabh, as Barack Obama said in an interview to Shekhar Gupta some years back at an earlier publication, it's like the stars are aligned, or you call it serendipity. The stars seem to be aligned by some kind of magic, we want to call it, or serendipity, or it's India's time. The last aspect of the three aspects you wanted to talk about, economics, technology, and politics. How do you categorize the politics of the last 10 years in connection or in the context of what you have said so far?
Yeah, so I'm not going to take political sides here because I have no locus standi to take political sides, nor do I have any qualification, any experience in politics to take political sides. What I will say is that the nature of voting, especially in national elections, but even so I've seen in state level elections, the nature of voting has become very powerfully driven by how politicians project themselves on not just mass media, but also on social media, right? This is a change I think has taken place the world over, right? And politicians like Trump are obviously a manifestation of that. But I think it's a change we are seeing at the national level, at the state level, even in local elections. The ability of a politician now to communicate to the masses very effectively through social media has become a critical element of election winning. I'm not saying that the old horse trading, the issues around caste and community have disappeared, but the ability to come up with a sellable agenda, right, beyond roti kapda makan, the ability to come up with a sellable agenda which does well in a medium like the one you and I are interacting with, and the ability to convince, to sway people as they sit in their homes at 8 in the evening staring at their smartphones. That ability has become central, right? This is true not just in the big cities, but even in the countryside. And I'm not sure, again, just like many investors haven't clocked on to how fundamentally the country has changed, right? Many investors I see haven't clocked on to the profit polarization story. I get the distinct impression that many politicians haven't clocked on to this change. And necessarily, therefore, whether it's in the state or at the center, politicians who are awake and alive to how the medium of communication has changed, right? Being relevant in, say, giving learned interviews to the English language press, which will appear in the morning newspaper, doesn't cut much ice anymore. On the other hand, having a very vivid, very powerful video in a vernacular can make all the difference. That change has then played out at the voter level. The voter level change, in turn, has then catalyzed policies which are driven by regional politicians to help the regional economy, right? And in turn, we therefore see when we travel around to states beyond, to state capitals beyond Bombay, Delhi, we see the ability of local business people to lobby the local polity to create changes which are state level, state friendly, have a bearing on wealth creation. So very interesting. 20 years ago, it was all about the big cities and about Sarkar in Delhi. 2021, local politicians, local policies are far more relevant, and that in turn interplays with the rise of social media.
I have a question here which is politically agnostic, Saurabh, and this is a trend we see across political parties. So we don't have to, take any political, sides or be critical or anything, but it's a political trend across political parties, which is welfareism and just giving people. It could be a cycle, it could be a laptop, it could be a promise of a smartphone, it could be free power, it could be free water, and making large sections of the population dependent. And there comes the question: do you want to teach people to fish, or do you want to just give them fish? So isn't that a bit of a contradiction?
Right. So I think the age-old story, which obviously is not going to disappear overnight, is the the inability of the Indian state to deliver at the last mile the basics of life, right, which is health, education, safety, security, and so on. So clearly, the last decade is not long enough for you and me to comment on whether the Indian state is any more or less capable than it was a decade ago. But the issues around the inability of the Indian state to deliver the essentials of life to 1.4 billion people, that's a well-known deficiency. It's still there. In that context, for as long as I think I've been alive, Rajesh, as long as you and I have been alive, we have seen politicians do handouts. When we were a super poor country, on the brink of famine, the handouts used to be basically milk and rice and the basic food materials. We were a super poor country. The public was grateful for being kept alive. Today, one sign of progress is the handouts are laptops and pressure cookers and cycles. It seems like that itself is a sort of progress. I don't have data to show whether that wins elections or not, right? It's been a staple of Indian democracy, this handout culture. I remember in the 80s, we had progress to giving out blankets. And now from blankets, we progress to laptops. The fact that the handouts are more generous seems to be something to be happy about. I'm not so sure that swings elections. As I said, what seems to swing elections is the ability to appeal to local people on local issues. So if you're fighting an election in Tamil Nadu, you got to play it on local elections. If you're fighting an election in Bengal, ditto. It's very interesting, right? Even though economically the country has got integrated, politically, the themes which define elections seem to have become far more regional, far more local. And I find that fascinating, that economic integration, it's the same free market economy which is powering our lives. GST has interlocked the country in ways that simply wasn't possible a decade back. But because of the rise of social media, playing to local themes, state level themes has become far more powerful. And politicians who seem to successfully do that seem to emerge triumphant in local states. And one simple way to assess the power of this is the balkanization of states, right? The fact that we're pushing towards smaller and smaller states is evidence of the fact that people want more local control. They want politicians who represent their local grievances and concerns rather than someone sitting 300 kilometers away in a state capital.
But which is also where the question of disparities come in, Saurabh, where you have a southern state, a Tamil Nadu, which is far ahead of a Bihar or a Uttar Pradesh, or a Bengal, which is somewhere in between. So that is the disparity we see.
Sure. So this is where I think let's go back now, link back to the economics point. One of the things we've seen, right, and we've studied this in great detail because our careers and our portfolios hinge on this, is whether you look at America 1880 to 1930, Japan in the 50 years after the Second World War, Korea in the 50 years after the Korean War, right? In all of these countries, what we have seen is the core of economic development comes after the interlocking of the nation and after the rise of, say, 15, 20 dominant companies who end up basically dragging the country forward because of self-interest. Sheer self-interest propelled the Carnegies and the JP Morgans and the Vanderbilts and the Rockefellers. Sheer self-interest propelled these promoters in America, as they called them, I think, robber barons. It propelled them to drag their own businesses forward. As they did so, they dragged America into the industrial age. And very similarly with, say, Japan and the conglomerates in the wake of the Second World War, or Korea and the five chaebols that dominate Korea. Now, what's most interesting is that the core of economic empowerment for the people comes after the rise of economic concentration, right? We couldn't find a single example of a country anywhere where economic empowerment, delivery of the last mile economic essentials, right? Education, healthcare, safety, security. We couldn't find a single example of a country where the last mile delivery happened before economic integration. Right now, why does the sequence work like this? I don't have enough knowledge to give you a convincing answer, but it does look like first you integrate, then you economically consolidate the country into the hands of 15, 20 companies, And after that, the last mile delivery comes through, right? So if you were to ask me, the last mile delivery hasn't happened in India. It's evident from a whole host of inequality statistics which come out from many different sources, whether you're left wing or right wing. It is but obvious that the last mile delivery hasn't happened. As a result, programs like NREGA have played a critical role in the last 10, 15 years in keeping millions of Indians alive. History suggests that in the next 10, 15 years, the last mile delivery improves. And I think that's something that will be looked at very carefully. Can the Indian state stand up and deliver higher standards of education, healthcare, and law and order as the country becomes more prosperous?
So those 15 or 20 companies, you see them happening in India. You see at least maybe half of them are already born and are in business, and maybe the rest are on their way.
Yeah, so in a way, the companies are already there, right? So in most sectors, the leadership is already very evident. So as we've written in our newsletters and in Diamonds in the Dust, if you look at adhesives, Pidilite dominates. You look at paints, Asian Paints dominate. You look at baby milk powder, Nestle dominates. You look at financial services, banking generally, HDFC Bank, HDFC as a group generally, Kotak Bank are incredibly well-run, powerful companies. Now, the question then becomes, obviously, these companies are going to carry on doing well. They'll carry on compounding for their shareholders. Is there a broader benefit for the rest of society? And this is where I think, the lessons of history are interesting. Typically, if we look at, let's take again Japan or America or Korea, typically one of the most powerful triggers for dominant corporates to push the polity to deliver the last mile is the need for skilled labor. As you get bigger, you need more people. Already in our country, as you must have heard from many sources, skilled labor shortages are endemic. So this is really interesting, right? On the one hand, we have a massive NREGA program to keep people from starving. On the other hand, we are a country where truck driver shortages happen within 2 years of an economic boom. In a country where you go and ask any labor recruiter, whether it's in Gurgaon, in Manesar, in Gujarat, in Hosur, in Pune, you ask any industrial recruiter, he'll say to get high quality industrial labor. These are people who earn 1.5 lakhs a year, right? Nothing more than that. For that, you need to give 15-20% pay rises, right? So we're a country where skilled labor shortages are already endemic, right? Every industrial district in India talks about skilled labor shortages. The question is, will the dominant companies in our country go to the government and say, let's do, for example, more ITIs, right? It's it's relatively clear that an ITI qualification is highly valued by recruiters who recruit for factories. We don't have enough ITIs. ITIs are not particularly expensive to build. We simply don't have enough ITIs. Now, it doesn't seem to me to be an incredible leap of thought to believe that dominant, well-run large companies with strong balance sheets will go to the Indian state governments, will go to the state governments and say, we will fund the ITIs. Can you give us the permission to build the ITI? Right? The state's financial resources are also not required, I reckon. Right? Industry itself will fund the ITI, provided the state says we'll give you the permission. And I think, and this story, the analogs of this, the analogs of the story, you can see playing out in America at the turn of the previous century, and you can see the analogs of the story playing out in Japan and Korea. Powerful, highly profitable companies approaching the state and saying, "Can you give us the permission to expedite economic development, which is beneficial for us?"
So that brings us to the point of the demographic dividend, Saurabh. Everybody has been talking about it for the last, say, 10, 20 years, and that, India is at this fantastic opportunity. The million opportunities is about the demographic dividend. And the point you made about the lack of skilled labor and people going for Narega jobs because they don't have any other way of earning a livelihood. That is again a contradiction. So, India is also a country of, I would not want to say million, but several thousand contradictions.
Yeah. So I've never quite understood this demographic dividend story, honestly, and neither have I ever espoused it, nor has anybody else in Marcellus espoused the demographic dividend story. I think demographic dividend is the most lazy form of economic research you could imagine. If all it took was to have a lot of young people, then there'll be plenty of economic development stories the world over. So I'm not so sure there is any demographic dividend story to be told. What our work, our travel, our research is clearly showing is, as the country is getting integrated, it is creating opportunities for well-run companies. Some of the well-run companies, as I was saying, are already large, dominant players at a national level. Some of the well-run companies are regional leaders. The fact that opportunities are available and can be grasped is evident to high-quality management teams. Capital is available. Talent is scarce. Talent, whether talent to write for the print or talent to drive a truck. Both types of talents are scarce. And therein lies a role for the state. If the state doesn't fulfill the role of upskilling Indians, my reckoning is industry will step forward and say, we will do it, give us the licenses and the permissions to set up the relevant training institutions, colleges, perhaps even universities, and expedite the training of the country, because the rewards for hiring and training talented people are very high, right? What better example can I give you than TCS, the world's second largest IT services company, right? Gigantic, $100 billion operation. I think they train or retrain, Rajesh. TCS trains/retrains, I think 2.5 lakh people a year, right? And one of the fact that they have to train or retrain 2.5 lakh people a year tells you about the colossal need for our country to get to upskill talent.
So, Saurabh, I just pulled out some numbers before we got talking, and I'll just get that data. It's basically the big numbers everyone talks about, things like GDP, things like per capita income over the last 10 years, over the last decade, and the graph, and I'm sure you would have seen this data. Is also like GDP growth rates have gone up in one direction, and obviously because of the post 2016-17, and you can blame it on demonetization, you can blame it on implementation of GST, although we talked about GST earlier, and the pandemic, the rates obviously took a hit. Again, when it came to per capita income, the year-on-year growth rate kept growing, peaked at 6.9 in 2016-17, and then again, the curve is in the downward direction. But you look at the markets, you look at the Sensex, you look at the Nifty, it's just in
Rajesh,
one
I think
direction.
2 points to make here. Firstly, there is no correlation anywhere in the world, anywhere, not in Japan, not in America, not in Taiwan, not in Zimbabwe, between GDP growth and the stock market, right? There isn't any, and we'll come on to in a bit why there isn't. So a lot of people who draw this, link is a bonkers link. I mean, it's like saying GDP growth is high or low, and Saurabh Mukherjee is having more or less for dinner. I mean, there is no correlation. Whether I have more or less for dinner has got nothing to do with GDP growth, right? So you might as well sort of compare ice cream consumption in Bombay with GDP growth, right? It's a bonkers link. I don't know why people do it, why people try to link the stock market with GDP growth. It's an apples versus oranges comparison of zero utility in Zimbabwe and in India, right? Now, let's get to the economic slowdown point, because as I said, it's a facile discussion between GDP growth and stock market. Let's get to the discussion on why has GDP growth slowed down. Firstly, if you look at World Bank data sets, and they're quite easily downloadable, India's GDP growth crested in the 2004 to 2008 period with other countries. India's economic growth slowed down in the last 10 years with other countries, right? There's nothing abnormal about the cresting of Indian economic growth in 04 to 08. Neither is there anything particularly sinister, as many people try to attribute it to, in the last 10 years. More interestingly, and this is both a comment on how integrated India is with the world economy and a comment on how little our policymakers actually can affect in terms of economic growth. If you look at India's economy since 1980, right, and I'm choosing 1980 because that's broadly 80-81 is when the liberalization started. The first layer of liberalization started in under Mrs. Gandhi, and then the second layer started with Manmohan Singh and Narasimha Rao's 91 actions. If you look at India's economy since 1980, every single economic recovery in India, every single one, comes in the 1 to 2 year aftermath of a US recession. Right. In fact, before 1981, India hadn't had an economic recovery between 47 and 81. So 1979-80, America goes into a recession. Ronald Reagan gets elected. India starts liberalizing its economy ever so gradually in the early 80s. We get our first ever economic boom between 83 to 87. Right, I remember I was in school, primary or middle school then. I remember seeing my schoolmates getting their first Maruti cars and even a few imported cars, and we were ever so envious of schoolmates who used to come to school and imported cars, right? So America goes into recession, 79, 80, 81. India's first boom starts 83, ends in 87. Then America goes into recession 89, 90, 91. India's second economic boom starts 93, again ends around 96. Third American recession after the dot-com bust and 9/11. India's third economic boom starts 2003, 4 and ends at Lehman. Lehman creates another American recession. India's next economic boom starts after Lehman, ends around 2011, 2012, right? COVID creates a recession in America last year. India's fifth economic boom starts in the wake of COVID. So point I'm driving at is a necessary and a sufficient condition. A necessary and a sufficient condition for a boom in India is a recession in the United States of America. A recession in the United States of America gives India two things which we desperately need, which is cheap oil and cheap money. A US recession pumps the price of oil down by 50 to 80%, right? We get sasta tel. A US recession pushes down the US 10-year bond yield by 2.5%, which gives us cheap money. You give this country cheap oil and cheap money, it does not matter what the political discourse is, we will have an economic boom. And that's exactly what we are going through. So for all the sort of learned inquisitions that take place in the op-ed pages of our our newspapers about kyun growth slow down kiya, kab zyada tha, kab kam hai, I'm afraid there is zero link between prevalent policies and GDP growth or whatever policies were being expedited in the 04 to 08 boom. We crested with the global economy, we slowed down, and as we've seen in the last 12 months, you give India cheap paisa and cheap oil, you get an economic recovery, right? So the economic waves, the economic cycles are highly correlated for our country with the global economy, specifically the United States. But the link between that and the stock market, zero. Why? Because the stock market, as we discussed 5 minutes back, has become dominated in the last decade or so by 20 powerful companies who are now taking home 80-90% of the nation's profits. And therefore, the link is broken between GDP growth and the well-being of these companies.
So, Saurabh, how do we ensure America has another recession? I'm just being flippant. But
you don't have to know. We have to live with the fact that economies have cycles. We've had a downturn in our economy. We're living through an upturn. Like every economic upturn, this upturn too will crest. It will go down, and that's the nature of a free market economy, right? One of the biggest ironies, if you ask me about how our economy has changed, we have. Partly because of the sheer incapacity of the Indian state, we've become more and more free market, even more free market than people understand us to be, right? If you have a free market economy, it brings with it great opportunities. Nika's IPO being a great example, but it brings with it economic upswings and downswings. There is no political party anywhere in the world. There's no central bank anywhere in the world which can insulate us from that economic cycle. If we want insulation from the economic cycle, we can go back to the socialist era where we used to have 2% GDP growth perpetually, which means per capita income growth was zero basically for 30, 40 years. And it ruined the lives of our parents' generation, right? It ruined the lives of our parents' generation, right? It condemned us to listening to cricket commentary on transistor radios, right? So we can either have 2%, 3% GDP growth with no economic cycles, or we can have fluctuating, waxing and waning of the economic cycle, which comes with a free market economy. And there's very little any government or any central bank anywhere in the world can do, even though they might pretend that they've got lots of levers in their hand to flex. It's for them, it's their place to pretend, and perhaps if I was in their place, I too would pretend. But it doesn't behoove you and me to fall for that. We got to realize that in a free market economy, opportunities are going to be grabbed by those who are the fittest, the strongest, the cleverest, the hardest working, which in turn creates economic polarization, which we have in plenty in our country.
I was just being flippant when I said, how do we ensure America has a recession? But right now, at this point in time, as we speak, oil is not cheap, and the fear is of another taper. It's not a fear, the taper will happen.
You see, Rajesh, again, these are copybook cycles. So let's take 2004 to 2008, right? India's sort of moment in the sun, so to speak. 2003, America started recovering. They had cut post dot-com bust, post 9/11. America had cut rates by 2.5%. China started getting cheap money 03. We started getting cheap money 04, 05. From 2004 onwards, the Fed started tightening. I remember 2004, middle of 2004, they started tightening, right? So typically a year into an economic expansion in America, the Fed starts tightening, not rationally. So if they didn't, somebody would ask difficult questions. So 2004, Fed started tightening. Oil started rising as early as I think late 03. The boom carried on till 2008 Jan, right? And very similar dynamics in the early 90s. So you need cheap oil and cheap money to trigger the upcycle. Naturally, cheap oil and cheap money are not going to last the entire upcycle. If it did, the upcycle would last forever. Yes. So once the economic recovery becomes pronounced, a rational central bank, I'm pretty sure both the RBI and the Fed will do it, they'll start hiking. But by that time, the animal spirits have been ignited and we are off to the race courses. If our supply side was stronger, Rajesh, if we had more educated people, more skilled people, our booms would last longer. Right? Our booms would last longer if our supply side was stronger. But it is what it is. The Indian state's incapacity to deliver the supply side, right? The Indian state's incapacity to deliver, say, industrial land, which is cheaply available, right? The Indian state's incapacity to deliver skilled labor means that economic booms typically last, say, 3 years. 4 years ho gaya to miracle ho jata hai. But 4 years, I think, is very rare. That 04 to 08 was an exception, right? 3 years is typical. If it's shorter, it'll be 2 years, right? So the Indian state's incapacity to deliver supply side reforms means that our economic recoveries tend to be typically 3 years. And when we are unlucky, early 90s, I think we were unlucky, you get, say, booms which are as short as 2 years.
Last question, Saurabh, before we take questions from some of our viewers. So like we promised, how can people watching this take advantage of the changes and gain from the changes we talked about?
Sure. So I think the first part is to sort of recognize the change, right? A lot of people in our country, and this is especially true for, say, people my age and a little older than me, they still live in the 20 years ago ka era. So just to be clear, what do I mean by 20 years ago ka era? So back in 2003-04, the 10-year bond yield, the 10-year Government of India bond yield was 16%, right? We were a high inflation, high cost of capital country, right? Fragmented country, high inflation, high cost of capital country. Now, if you have 16% 10-year bond yield, and this was true for most of my childhood, people like my parents were justified in putting their savings in Government of India bonds, right? They were justified in fixed deposits and Government of India bonds because they would make a decent return on their money above the rate of inflation. And they had, being middle class Bengali people, they had zero idea about the stock market. And therefore, from 1947 to say 2007, perhaps even 2017, the Indian middle class packed away their savings in buying flats, buying land, buying gold, and whatever financial assets they had would typically be FDs, life and LIC policies, and government bonds, right? Stock market in many families like mine was a dirty word, right? Stock market was for rich people in Bombay, typically from the Gujarati Marwadi community, self-respecting middle-class people said, "वो stock market में नहीं घुसना, दलाली चलता है वहाँ पे, casino है," right? Now, that paradigm has changed, right? Why has it changed? Firstly, the 10-year government bond yield is now 6%. It's not 16, it's 6. After paying your taxes, you're not going to make any real returns buying Government of India bonds or whatever pure life insurance policies, right? Or indeed fixed deposits. Neither are you going to make a real return from buying gold or land. You might make a modest return from buying land or flats, right? But it's not going to be enough to finance your savings, right? Remember, life expectancy has gone up as well. So most people in your and my social strata typically live till the age of 85. They retire at 60, they live for 85. So 25 years, you're going to finance a retirement. You're not going to be able to do it with flats and gold and FDs and GSECs. So the compulsion to invest in high return assets is actually very, very strong. Even for affluent people watching this program, you cannot fund your retirement if you don't invest in higher return assets. Now, life being what it is, the main primary high return asset available in India is stocks. Yeah. Now, how you invest in stocks is a sort of secondary issue. My request to everybody watching it is consider investing in stocks on a proactive basis, because if you don't, there's a very high chance you'll run out of money long before you die. If you want to come to the stock market, you have a couple of choices. You can either look at mutual funds, or if you have the requisite amounts of money, you can come to PMS managers or AIF managers. The way SEBI has structured the stock market is the mutual fund is the mass market product available for people who have as little as say 5,000 rupees to save. PMS is 50 lakhs or more, and AIFs are 1 crore or more. So it's structured for different levels of wealth. If you don't want to pay fees to a fund manager, there's something called index funds or ETFs, where the fees are very low, and you basically track the Nifty or the Sensex. That's a very legitimate way to participate in the stock market. You're basically getting exposure to India's largest companies. And if you look at the returns that the Sensex or Nifty have delivered since say 1979, you'll get 12-13% returns over long periods of time. Even after paying taxes, your wealth will compound at say 10-11%. That gives you a fighting chance of having a solid retirement from 60 through to 85. So that's the shift. In our parents' generation, the right thing to do, both given the immaturity of the stock market then and given the high returns available on government bonds and FDs, was to go the GSEC and FD way. In our generation, that's no longer the case, but a whole variety of Indians haven't clocked onto that. And as a result, Rajesh, you and I sit here in a country where the middle class is around 200 million stock. The number of demat accounts are just 22 million. Just imagine, just 22 million out of 200 million. That means 180 million Indians are not planning for a decent retirement. And that should worry everybody, all of us, including those who are invested in the stock market. 180 million Indians. And we're talking about middle-class Indians, people who are earning reasonable sums of money, but they're not saving it properly. They're saving it in low-return assets. They're saving through real estate, gold, FDs and GSECs, which is not going to give them the retirement that they deserve. And that's what I think, that's what we need to sort of galvanize opinion around. Say, use your money. There's something called the NPS, National Pension Scheme, very low cost. I think it's 0.05%. I have an NPS scheme as well, 0.05%, and save for your retirement using the NPS. It's a very well constructed, low cost way to save for retirement via the stock market.
Thank you, Saurabh. That was very insightful, and we'll go and take some questions from some of our viewers. Okay, the first question is from Yash, and we got this question from Yash on Twitter. Thank you, Yash. Saurabh, in most of the interviews, talks about how in India there will be a boom cycle due to the recession in America. Somebody who's been tracking you and what you've been saying. The cost of capital has come down and has benefited India, but crude prices are on a higher level and not as you predicted. What's your take?
So as I said in the main part of the show, Rajesh, if you look at this boom, the preceding boom back in 2003 to 2008, the early 90s boom, it's never the case that money and oil stays cheap through the boom. It can't happen. Logically, it's inconsistent. If America booms, within 1.5 years of the boom, cost of capital and oil prices start rising. What you need is cheap money and cheap capital at the outset, right? So 2003, 2000 to 2003, America had a recession. Cost of money dropped by 2.5%. The cost of oil dropped by 60-70%. That triggered the boom in India starting 2004. Within a year of that, the Federal Reserve started hiking. Oil prices started rising very considerably by 2004-05. But the boom continued till 2008. So you don't need money and capital, money and oil to stay cheap for the entirety of the boom. It never happens. It's logically inconceivable. You simply need money and oil to stay cheap at the outset to trigger the boom. Once the capex machine is underway, once animal spirits are ignited, and I can tell you with a great deal of confidence, animal spirits are wildly ignited in India today. Right? So you speak to any banker who finances companies, working capital and capex project finance is once again picking up. You need to just see the level of private equity and venture capital money flooding into the country. Animal spirits are ignited, and now logically, therefore, cost of capital should rise, interest rates should rise both in America and in India through the next year. Oil prices have already risen. I'm not so sure how much further they'll rise, but we can deal with this given that the economic boom has been triggered. And by the way, there's no great science here. It's not as if I'm telling you some great bit of soothsaying. If the global central banks pump in $12 trillion, which is what they did in January, February, March 2020, if the global central banks pump in $12 trillion, you'd have to have some really messed up economy not to have an economic boom after that.
The next question is from Sarkar. It doesn't say whether it's Mr. Sarkar or Ms. Sarkar. We come across a common narrative these days like insurance, gaming, EV, e-commerce, etc. And every sector is said to be unpenetrated and there is a huge potential there. How many of these are really truly unpenetrated and where do you see the potential?
So whether a sector is penetrated, underpenetrated, unpenetrated, I don't think Mr. Sarkar, Mrs. Sarkar, you need to lose that much sleep. What you, I, Rajesh, all of us need to lose sleep is firstly, is the promoter a crook? Is he stealing money? If he is, it doesn't matter if the sector is underpenetrated. You're not going to make money. I'm not going to make money. Secondly, even if he is clean, does he actually have the intelligence, the brains, the rationality to build a decent business? Because if he doesn't, he's going to get destroyed by smarter rivals. And thirdly, even if he's clean and he's rational, does he have a business which has high barriers to entry? Does he have a dominant franchise? Or is he one of those where if the rival comes in with a product which is 30% cheaper, iski dukaan band ho jayegi, right? So you and I shouldn't be losing sleep. This sector underpenetrated hai ya overpenetrated hai? Useless question to focus on. Three things we need to focus on. Is the promoter clean? Is he rational? Does he have a track record of intelligent, rational behavior? And thirdly, does he have a dominant franchise which rivals can't really compete with? If those three boxes are ticked, don't worry about penetration. Just go and load up.
The next one is from Falak Kalyani. The trader mindset of people is shifting from stocks to crypto. What is the potential of crypto? What is the future of crypto? And what do you think about US stocks as a substitute to Indian stocks? Crypto is something which I also wanted to ask you, but somebody...
Excuse myself on crypto. I think you're far better off asking people who are specialists in crypto. I think crypto specialists are walking around outside my building on the street. And I think if you walk out of your building to a local coffee shop, you'll find a crypto specialist. So I'll excuse myself from volunteering my illiterate thoughts on crypto. On American stocks, same paradigm holds, right? So if you can find companies in America, India, which are clean, rational, and dominant, you should be investing with them. What we tend to do using our LRS money in Marcellus is we follow a 2/3, 1/3 rule. 2/3 of our money we put in clean, rational, dominant franchises in India. 1/3 we do in American stocks. We don't do it ourselves. We've got a fund manager in London who does it for us. The reason we do the 2/3 in India, 1/3 in America is dominant Indian franchises tend to have return on capital which are twice as high, or actually more than twice as high as dominant American franchises. So typically the Facebook and the FANG stocks, Microsoft, etc., their return on capital is around 20%, whereas the dominant franchises in our country have return on capital of 40-45%. Since the return on capital is the main driver of how much surplus capital a company can plow back into the business, typically an Indian company reinvests twice as much as a dominant American franchise. And typically, therefore, dominant Indian companies grow twice as fast as dominant American companies. And therefore, on that premise, we invest twice or two-thirds of our equity assets in India, one-third abroad. You can do a different ratio, but yes, it is worth investing in clean, rational, dominant franchises, even outside India.
The next question by Prathamesh actually touches on the point of change we talked about during our earlier conversation. And he says, in the Indian markets, you have FMCG companies. He names companies such as Dabur, Marico, Godrej, which took years and years to build a large distribution network, while internet companies such as Nykaa scaled so quickly. So how should investors today value the new companies, the new internet companies that have a strong online and social media presence vis-a-vis the old generation brick and mortar companies?
So I think valuation of all companies the world over remains the same, right? You value a company basis how much cash it will generate for you in the years ahead. And so whether it's a Nykaa, a Zomato, whoever, Paytm, whoever it is that you want to value, you're going to make an assessment of kitna cash banayega ye company. How long will they generate cash for? So just to give you a sort of basic way to think about it, if you open up an Excel spreadsheet and put some simple numbers in it, if a company can grow its cash flows at 25% for the next 5 years, roughly you pay 25 PE for it. If the same company can grow its cash flows at 25% per annum for the next 15 years, and uske baad it fades away, you pay as much as 80 times for it. And if the company can grow its cash flows at 25% for the next 25 years, you can pay even 280 times for it, right? So if you want to invest in whichever company, whether it's internet or non-internet, you'll have to, as an investor, make a call on how long can this company grow its cash flows. Now, often in many digital companies, there is no cash flow to speak of. That's not because these guys are good or bad. It's because the way they're reporting the numbers hides the fact that whilst they have some sources of cash generation, they're investing in new areas. So if you want to invest sensibly in internet companies, you'll have to ask them, in the parts of the country where you began 10 years ago or 5 years ago, whenever you began the business, in the core of your business, which you began at the outset, how much cash do you generate in the core of your business? Because that'll give you a sense of, iske engine mein cash generation ka dam hai ya nahi, right? It's all right if for example, if the company starts out in Chennai and generates lots of cash in Chennai, uses that cash in Chennai to invest in Bombay and Delhi, and therefore in totality doesn't generate cash, but in Chennai generates cash, you can then use the Chennai mathematics to create a valuation of the company. But if the company tells you, boss, I don't make money anywhere in the country, कहीं पे भी मैं पैसा नहीं बना सकता, then obviously you'll have to make a very tough call on, the company's never made money before, in no part of the country does it make money, will it ever make money, and therefore should I invest in it, right? So there are both types of digital companies. There are some digital companies who are coming through who I think have very strong cash generation engines, and there are plenty coming through who actually have no cash generation engine. It's basically a bit of a sham.
And this is our last question, and the question is about Marcellus, and it comes from Karam Chandani. What are Marcellus guys doing for less affluent people like me who don't have 50 lakhs for their PMS, and how should retail people invest in the market? So
with exactly that point of view in mind, we're doing three things. Firstly, we are writing books. It's bloody hard work to do this. I get a lot of grief from at home because of the amount of time my colleagues and I spend writing books. We try to publish a book every other year. Because COVID gave us some extra time, we've been able to publish 2 books in 2 years. So if you want to access our books, Unusual Billionaires, Coffee Can Investing, The Low Risk Route to Stupendous Wealth, and Diamonds in the Dust. Diamonds in the Dust. All 3 books are available online. They're also being translated into Gujarati, Marathi, and Hindi. Audible versions of Unusual Billionaires and Coffee Can Investing is already available. Diamonds in the Dust audible version is currently being recorded. So this is our lifetime's wisdom. We put it out there for whatever 200, 300 rupees. If you're lucky enough to get a pirated copy, which as you can imagine is not very hard to get, you can get it for free, right? Infinite return on investment aapke liye. So that's the first thing we're doing to make sure everybody benefits from whatever knowledge we have. Our books give you away pretty much our entire portfolio. Secondly, our website is free. Our website is absolutely free. All our research, every blog, every newsletter, pretty much every portfolio is on our website, free of charge, right? So again, if you are interested in building your own portfolio, go to our website. It's available free of charge. Thirdly, if you're a busy person and you can't be bothered to go to our website, you can go to our website and register yourself for our emails. Every time we publish something, you'll get a free email saying what is Marcellus doing. So you can go to our website and register yourself free of charge, and we will put you on our email list automatically. You'll get all our knowledge free of charge. You'll also get invited to all our webinars. We typically do a webinar every month, sharing with our colleagues, sharing with our clients and with our circle of friends what we are thinking about investing. So we're doing whatever we can to share our knowledge free of charge to millions of Indians. Please make the most of it. It's our way of giving back because we've got a lot from this country. This country has taught us a lot. It's a privilege to live here, work here, and we want to do whatever we can to share whatever little we know.
Thank you so much, Saurabh. That was a fantastic, almost an hour of investment advice, but I would say it's not the kind of investment advice people expect. But this is the story of a changing India, the opportunities, and as Saurabh said, a million opportunities there. So track the change, study the change, and spot the opportunities and invest. That's, I think, the summary for all of you who watch this, and we will be back in next quarter with another show, with another equally interesting, if not more exciting theme. Please do keep watching us. That was the first episode of Quartermaster for you. Thank you, Saurabh.
Thank you very much. Thanks, Rajesh.